I got to tell you, it's like just a few minutes after that number came out on Friday, my first thought was, are we even talking about rate cuts anymore? I mean, do we even need to?
Right.
I mean, that's I'm glad that I'm not the only one that was thinking that way because I thought, what am I missing? But I think it's the whole, those keywords of being patient, and what was that word that he kept using over and over again after during his press conference was being confident, and being confident that inflation is coming down to 2%, et cetera, et cetera, et cetera. They need a lot more confidence that that inflation again is coming back down to target before they actually start to raise rates, and of course, or start to cut rates. And of course, this kind of number throws, I think, everyone off, off completely. So you have to sort of, rejig it a little bit, rejig the communications a little bit, but sort of keep the story on path about rate cuts coming, but just not sooner rather than, but later, of course, not rather than sooner.
Yeah, Jennifer, recalibrating those rate cut expectations, when do you think the Fed starts to pull the trigger? I'm just looking at the WIRP function, WIRP, on the terminal. Pricing in right now in June, then July and September. What are you making of that?
Yes, that sounds good to me. So we haven't, we were debating this on Friday as well, but we're going to stick to our July rate cut for the first move. We had always, wondered what we were missing, why the market was thinking about March, but I'm actually quite glad that Fed Chair Powell sort of put all those concerns to rest by dismissing March last week. But we're going to stick with our July rate cut to be the first move, and then four moves in total during the year, so 100 basis points in total for 2024.
Hey, Jennifer, you look around the world, and it seems like the U.S. economy is kind of the exception here rather than a rule. We've got continued weakness in Europe, even including obviously the most important economy over there being Germany. China, just well below expectations. Does it surprise you that maybe the U.S. is doing as well as it is, given that its main trading partners aren't?
A little bit. I'm going to admit that a little bit makes me a little bit concerned. At the same time, I'm just always wondering, what's going to come down next that's going to throw everybody off. But it gives support to the IMF last week and the OECD this morning, raising their global growth forecasts for this year and sort of steady-ish for 2025 on the back of a strong, resilient U.S. economy. Remarkably resilient, I think, was what the IMF called it. And meantime, it stands in stark contrast with what we're seeing in China with, roughly 4.5% growth this year. And Europe, which I think is just barely just struggling to even grow. We're looking for about a 0.5 percentage point increase this year. And that also shows up when you're looking at the different central banks. You've got the Fed, who's still, again, talking about rate cuts, but sort of pushing it off the start date further off into the distance. You've got the ECB debating, whether or not they're probably going to go in June, by the way. And then, of course, the Bank of England, who just ditched their tightening bias, and Governor Bailey said that point blank, and now they're talking about when rates are going to come down. So it's very much different discussions taking place around the world among central banks.
Yeah, Jennifer, Ben Emmons just told us, basically kind of reiterating Jay Powell's point that the biggest concern, if you will, is geopolitical risk. How are you taking that into account, just given the continuing wars going on across the pond?
That is probably one of those, those big sources of uncertainty that, that all the data in the world are not going to be able to predict. You've got not only just like the actual war itself, but of course the economic impact in terms of inflationary impact. It may not be what we saw back, in terms of supply chain issues, not what we saw back during the pandemic, but it's still having an impact, especially with, very few ships going through the Red Sea nowadays and going around Africa instead to get from like Europe to China or the other way around. So that's adding another 10 days. Last time I checked, all the ships are all using oil as well. So it's not an EV. It's not, they're not using batteries to run their ships. So this is all potentially inflationary, not as much as what we saw back in 2020, of course, but this adds a lot of pressure, I think, on what central banks are watching. Again, not only just the war themselves, but the economic impact.
Jennifer, I've seen the U.S. dollar kind of rallying here a little bit in the last several weeks. I guess expectations that maybe the Fed won't be as aggressive as maybe we originally thought in cutting rates here. How do you think about the currency markets and the dollar here?
So the currency market has been like one of the most toughest things to call over the past few years. It's been always, at least the last few years, it's been very much of a strong U.S. dollar story. Now this year we are still looking for the U.S. dollar to weaken somewhat. Just in theory, when you have the Fed starting to cut rates, that should take some of the wind out of the U.S. dollar's sails. But I think, and I've said this before, I think it's all about perception. If all the economies around the world are slowing, but the U.S. is slowing the least or at the slowest pace, if you know what I mean, I think that would actually give support to the U.S. dollar. So even though it's going to, we look for the greenback to weaken somewhat, I don't think it's going to be weakening as much as we had originally anticipated, say, half a year ago.